great time to get in a very special guest coming on media after a really long time. Parag Thakkar, fund manager at Santulan Investment, with us in our studios. Parag, so good talking to you. It's been a while. Thanks for joining in.
I am also really delighted to do a show with you after a long time. It has been a great pleasure.
Thank you. Look forward to the next 15 minutes, Parag.
Yeah, sure.
Trying to think, how do you think about the markets currently? We'll talk about some high-flying indicators first, but it seems that the market is caught in a very narrow range.
Absolutely.
What happens next?
So basically, why it is in a tight range, I would like to address that first. See, first, the Fed has turned dovish, and first rate cut of 50 pips clearly tells you that they are very serious. If you remember what Powell said on that day, that US economy is already on a solid footing, and we want to keep it there. And that's why the first rate cut was 50 pips, right? So they are very serious about job market, and they are looking at it very seriously. So that is a big positive in my view. Recently, from last 15 days, we have been hearing about China, right? China trying to improve its economy. I'm hearing that tomorrow, again, there's some meeting for improvement in the property market. So globally now, everybody is waking up to the fact that the growth is slowing down. And you need to boost economies, you need to stimulate economies through interest rate cuts. Of course, it is easy to do a monetary easing. Fiscal stimulus is difficult right now because debt to GDP ratios of the world are high. So, you know, in between also there was a talk of $283 billion stimulus in China, but the number did not come. Yeah, because everywhere there is a pressure on government to reduce the debt to GDP. Right? As we call it in the company is net debt to EBITDA. For government, it is debt to GDP, right? So that debt to GDP is a problem. And so to fiscally stimulate the economy is difficult. Monetary wise, you can also always reduce interest rates. And we saw that in India also, RBI changing its stance from withdrawal of accommodation to neutral, which is a good change, good stance change at the right time, I would say. And the other point is that stocks have run up. So basically, we have defied the traditional logic, right? Earlier, what we have read in Warren Buffett books and what we have understood is that when interest rates rise, the PE should come down. But in the last 3 years, in US, the interest rates went up by 5%. But the PEs have not corrected. They corrected in between during the Russia-Ukraine war, but they again went back because Fed was printing money from 2009, global financial crisis, right? So the wealth effect took it over. And so even when the interest rates went up, the PEs went up. So now we are at a stage where interest rates are going to get cut, but growth is definitely going to be a little bit weaker. And so the question is whether everything is priced in or not. And in India, to be specific, from March to September, you will not see any outliers in terms of big growth. Right. So, for example, if you see September quarter earnings, most of the companies like cement sector or banking, everything will be muted. Cement will be bad, very bad, but banking will be muted, hardly 10-12% growth, and we are coming from a 30-40% growth time. In fact, this is for example, Mr. Uday Kotak told that we are in a Cinderella time for banks, right? If you remember, is one of his calls. And at that time, the stocks were not performing because FIs were selling, because interest rates were going up. And this is that Cinderella time is almost over now.
So Goldilocks is used for the US and Cinderella is for us, is it?
And the valuations have also corrected. For example, if a stock remains at the same price for 3 years, which is in the case of say HDFC Bank or Kotak Bank or some of these banks, you know, the book value has actually increased, right? The underlying valuation of the company should have increased. But you can attribute it to the fact that because interest rates were going up, FIs were selling, and so the stock prices were not responding to the earning growth, right? So that is why there is a confusion in the market. In my view, what can change this is, from the positive side, if there is a global growth which comes back because of the monetary easing, and of course, hopefully some fiscal stimulus in China also, and in India also, because of the election, the heat wave, monsoon, all these 3 factors remain behind, and now, hopefully, we see slightly more improvement in the liquidity in the market first, and then, of course, followed by some rate cuts, hopefully by Feb. and government spending, which was actually absent from election time.
Right.
So if government spending comes back, then you can see earning growth from Q3. Festive is also there. So Q3, Q4 might accelerate earnings. September June and September were bad quarters in terms of earnings.
Parag, but the fact remains the Nifty is up 27% in the last 1 year. So we've very obviously borrowed returns from the future. Towards the end of last year, we've been talking actively that, you know, the markets are going to correct. It's wise to sit on some cash, you know, take profits off the table. Now, what has happened is defied reality to a great extent. In your opinion, have you been sitting on cash? And if yes, how much? And are you beginning to allocate that cash? Because while the Nifty is only corrected 5%, stocks have dipped 20 to 30% in the last couple of weeks.
Yeah. So definitely we were sitting on cash. Across the portfolios, we'll be having 8 to 12% cash. And that we always keep because if some geopolitical tension arises, then on that very bad day, we would love to deploy cash.
Have you deployed in the last 2 weeks?
Slightly, yeah.
How
slightly.
much? Of the 15%?
So basically, 3-4%.
So you're still sitting on about 12% of
yeah,
cash?
you can say around 10% cash, but that is the level of cash which I would generally keep.
Healthy.
Because in a current environment where stocks have gone up, as you rightly pointed out, and if there is a possibility of geopolitical problem happening anywhere in the world, right? You know, you don't know. And suddenly you wake up in the morning saying that markets are down 4-5%. You don't want to see a situation where you don't have cash on that day.
Yeah.
Right? So you have to have some cash, some firepower. And that's why there is some cash. But otherwise, I would say that we are not short of ideas at any point of time. Luckily, by God's grace, we are having many, many ideas. And I can share with you some.
It's just where is the money if it's all invested?
So let's talk about some of the ideas.
Yeah, so pockets of value I'll
Pockets of value,
yeah,
exactly.
I'll define that way.
By the way, standard disclosures, Parag. I mean,
Yeah,
you
sure.
may have your...
Yeah, absolutely. Very good that you reminded. So first of all, I would like to make it clear that whatever stocks I talk about or whatever sectors I talk about, these are my personal views. Second, they might not be in my clients' portfolios. And I would say that one should take an informed decision only after consulting their financial advisors, and just don't buy because I am telling something to buy. Because we all can go wrong. We are all human beings.
Yeah, sure.
Yeah. So first, biggest disclosure that I deserve to be wrong.
Now let's talk about the pockets of value.
Yeah, the pockets of value. See, I love a situation where, so in my past, when I was an ICICI Pru and other fund managers, I have benefited from one particular fact that if a very good high quality company means good quality promoter, good ROC, good free cash flow, debt free balance sheet, those kind of company goes through a stagnation phase of earnings. And market starts forgetting about it, or market starts giving it a lower multiple. And then there is a point, you know that this company is also doing something to address its issue, and it will bounce back. This has been my favorite playground. So right now what I see in current market environment is TCS. It fits into that investment philosophy. Okay, last 2 quarters were not that great. Margins this quarter was 24.1, which was below estimates. Because BSNL deal is a low margin business. They lost some business in US healthcare services thing. So hopefully they'll get it back. So I'm saying it, for the first time I'm seeing TCS being valued like exactly as per the Infosys and HCL Tech. So PE multiples of all 3 IT companies have converged to 25 to 26 times on FY26 earnings. Now imagine a company which is 15 lakh crore market cap, generating 50,000 crore cash profit last year, which is going to grow at 10%, right? So in FY27, in FY26, I would say, they will end it with 62,000 crore free cash flow, right? On a 15 lakh crore market cap. And the dividend payout policy is such that 85 to 100% of the free cash flow is given to. So I'm getting 3.5 to 4% dividend yield in a TCS kind of a stock. And Fed is supporting US economy. First of all, US economy is not doing that badly. And they are saying that they want to keep it there. US GDP growth was also good last. And if you see the earnings of, for example, to start with JP Morgan, they revised their guidance upwards. Goldman Sachs, 45% growth in earnings, right? Citibank, the profit fell, but it was above their estimates, their analysts' estimates, right? BOFA, So all these clients of Indian IT services are in great shape. They are in great, although US debt to GDP might look high, but the corporates to which these Indian IT services are catering to are in very good shape.
That makes great sense because you had Bank of America, Goldman, Citi that reported numbers
Yeah,
yesterday,
yeah.
and they've beaten every street expectation.
that's
so
what I'm saying.
If your clients are doing well, you will do well. Is
So
obvious.
it's like people are waiting for TCS to call out that yeah, there is a recovery, yeah, there is a discretionary
these are
spend
the green
recovery.
shoots.
But you have to buy stocks when there is uncertainty, and you have to buy great stocks during uncertainty.
So TCS being one, we need at least 5 in the next 5 minutes.
So,
being greedy.
So yeah, so second, I think second space which I would like to talk about is structural space. I would say is banking and financials, where there are pockets of opportunities. Of course, we all know SBI, ICICI Bank, great buys, and it's a consensus buys. But in small pockets also, like LIC Housing Finance. Just to give you one example, when we say that India is expensive, and this is, I think, told by Mr. Manish Chokhani in one of his shows, that see the PE multiples of banks. SBI starts at 7, HDFC Bank gets at 13. So we are not expensive. The 35% of the Nifty is not that expensive. Right, SBI, if you exclude the subsidiary value, which itself is very, very highly valuable, right? They can sell stake in Yes Bank, they can sell stake in NSE. If you just deduct all that, it is one-time book value and 6 PE. Now, 6 PE for a bank which is financing 25% of your economy, right? So, and as the SBI chairman said, right, that what is good for India is good for SBI, and definitely SBI has to do well. And we are not, for example, in pockets of finance also, there is a stress in MFI, right? There is a stress in unsecured personal loans, right? SBI doesn't do all that, right? So basically I'm saying SBI, ICICI Bank, even HDFC Bank to some extent, or LIC Housing Finance, or Federal Bank, Karnataka Bank, all these are good pockets of value in my view. Third, which I'll quickly touch upon, is cement when they report numbers. I think this will be a worst quarter.
Okay.
A worst quarter in my view, and I think many good companies will also report very bad numbers because the prices were low, demand was low because of monsoon. And now that after festive season ends, you'll see January, February, March is generally the good quarter for cement in terms of demand. And I think the profitabilities are at such levels that they'll try to increase prices. To some extent, if it gets absorbed, I think the worst will be behind after this quarter's result. So cement is definitely a space where we have not yet built in long positions, but definitely a space which we'll be looking at very closely at the time of the results.
So which cement stocks would you be eyeing very closely?
So basically, see, Ambuja, Ultratech are the larger ones, the leader ones, definitely. Then if you go below that, Shree Cement, Birla Corp kind of name comes up. Because if you see the calls of, for example, Shree Cement, they said that they'll not acquire anything. Right? They are going to just add 10 million tons every year from internal accruals. They already have 5,500 crore net cash. So I'm saying that I would like to back such companies which are not very aggressive because you are not very sure about the cycle.
And you'll allocate equally across the large ones?
No,
and the
no,
small
definitely
ones?
the weights will vary. For example, whatever weight I can give to say TCS or ICICI or SBI
Much
of the
bigger
world.
than the smaller ones.
Yeah, then this one ones.
Any hidden gems? You've talked about large caps, right? But I think the excitement sometimes is in that broader market stock that becomes a multi-bagger. TCS can only grow that much eventually.
Yeah, absolutely. So see, and let me complete the last value of pocket of value. That is in metals. So for example, if China is able to do materially well in terms of recovery, in terms of, then stocks like NMDC, which is, so for example, NMDC, if you see today, the price is 230. Next year, EPS is going to be around 28, which is with a conservative EBITDA per ton estimate. And net cash company, net cash of 9,000 crores, right? So EV/EBITDA of 6 times, or PE of 8 times. So I think you cannot go wrong there if the China recovery really happens. And I am not here counting on a big recovery. Because you are buying a net cash company. If I would have been very, very bullish, I will buy a leveraged company.
That's true.
Right? I don't want to play that in any sector because I am not very sure whether the cycle will really turn positive or not. Because as I told you, every economy is constrained on the fiscal front. So I cannot expect a big fiscal stimulus from everything, which will create a big, I would say a 2008 kind of a rally when China did bought the entire steel from the entire world. Those kind of thing cannot happen now.
So in metals, which was your top pick, you said?
NMDC.
NMDC.
And followed by Nalco.
Nalco. And beyond the big players, anything that you think you're eyeing or you're spotting from maybe a smaller sector or an upcoming sector in that sense?
No, so basically this is not my circle of competence. My circle of competence is tried and tested businesses.
Okay.
So basically, just for, we in past, in my ICICI Brew days, and, we bought a huge amount of Tata Consumer Products and Bharti Airtel and NTPCs of the world. So basically one thing which I would always prefer is a Tata Group company, if it is at an inflection point or if it is undervalued. This is my particular, I would say something which I love to do. In each of my portfolios, wherever I have been, whatever portfolio I have constructed, mostly I prefer that out of the top 5 holdings, at least one Tata Group company appears.
That's TCS for you.
Right now, it is TCS for me.
That's nice.
Because it is now ignored. It is now ignored. People have given up on it, and that is what I love. When people give it up on a good company, which will also do something to reverse its losing proposition, right? For its customers, it will do something, right? You cannot say that TCS will sleep. It's a sleeping elephant. It will wake up. And when it wakes up, everybody would love to buy it. So then you buy it before that.
Got it. Well, this was the key takeaway today, I think, Parag, which is that look at pockets of value in an uncertain world. There might be merit in looking at pockets of safety, companies having cash, but looking at growth aggressively at some point of time in the future. Thank you so much for joining in today, and all the best with Santulan AIF going ahead.
Thanks.
Thank you, Parag.
Really appreciate it.
Great having you in the studios. You really, truly were as impressive as Neeraj had highlighted.
And once again, I would like to say, don't go by my recommendation of stocks. It is just out of sheer love for stocks I speak about them. And please don't make your investments based on that. Please consult your financial advisors or keep it with the institutional investors so that they can take care of them.
And we hope to see you soon again on the channel.